Okay, well, CLSA is fairly bullish on a couple of beaten down banks. It began with SBI, which has now pretty much come to CLSA's target at 280 rupees. Their initial target was 300, so they're within shooting range of that one. RBL Bank has also been a very quick mover lately. It's made up a lot of lost ground, and CLSA has now come in with a very bullish 35% upside target for RBL with a target price of 330 rupees per share. There's a couple different reasons for this. In CLSA's view, RBL is currently undergoing a transformation from being a heavily corporate-focused bank and is attempting to pivot toward a more retail focus while managing the legacy issues of the old corporate book. So as that corporate book consolidates and credit growth is low, CLSA doesn't actually see this as a problem. They actually see it as an opportunity for RBL to work on developing the retail assets in certain niches, as well as working on the granularity and the retail focus within their deposit franchise. So they were known for having lumpy, bulky deposits, which is why when they lost those at the time of the Yes Bank fiasco, growth and obviously managing the cost of capital became significantly difficult for this bank. So today, in the environment where the corporate loan book is consolidating, that is the key focus area according to CLSA, right? And that will also enable them to bring down their credit cost. Now, the next thing is that this bank, although a very small one, has developed two very strong niches, and one is in the credit card businesses and the next is in the MFI book. So they actually had bought out RBS's credit card business, which they then partnered with Bajaj Finance, and today they're the fifth largest issuer of cards in the Indian banking industry, right? So that's a major feat. And they also have around a 70 billion rupee MFI book. So basically, these two together currently comprise around 20% of the overall loan book. They expect this to rise to 38% by FY23. And then they also expect that the COVID credit cost will be contained, and you'll be seeing ROAs of more than 4% for both the cards and the MFI business. So that should also drive further re-rating for an RBL bank. Apart from that, they also see that the valuations are still very low compared to all of the other private peers. So we all know where RBL used to trade. It was one of the most expensive banks. Now today, even if you take CLSA's target price of 330, that's just based on a very basic 1.3x December 22 price to book. So it's not that they're modeling for something very expensive, but they are definitely playing for some re-rating, as the current valuation is 1x FY22. So on the back of these reasons, they've initiated a firm buy. They like the bank and they believe that it is on a turnaround. CASA should also improve fairly soon with the focus on deposits. And let's see, maybe this is the next one to play catch up from the smaller private banking space after those like an Indusind.